And we're live. So, a very warm welcome to everyone who's joining the session, both the five wonderful folks here who are joining Kavita and me, as well as everyone who'll be watching the session live and catching the recordings as we kind of go forward through the course of the week. So today we have yet another mentoring session, and today we have our wonderful mentors, Sowmi Krishnamurthy and Eric Conrads, who are joining from practically the opposite sides of the world, and that's always exciting for us. And we have Parth, Javin, and Mukul, who are joining us as the top three performers for the previous week in the investment challenge. So, congratulations to you guys. And I think, in the interest of getting the ball rolling and getting out of the way of this valuable conversation that you guys are going to be having, I'll just ask one question because both Eric and Swami have very interesting overlapping and yet unique context. Eric, in addition to being an investment professional, you're a teacher as well. And Swami, you occupy a world outside just the traditional understanding of investment management in equities,
Right.
with your expertise in the areas of commodities and currencies as well. So, for both of you, my question, and we'll start with you, Eric, is what do you think the participants from the investment challenge? Because you, I remember last year, was it made participating in the investment challenge compulsory for its students as well? So, what do you think is the major takeaway that anyone participating in the challenge should learn?
Right. I don't know. Do you want me to go first or?
Um,
Yeah,
okay,
go first.
let's start. Yeah,
Yeah.
fine. Sorry. Let's start
Right.
with you.
Okay. As I was explaining to Kavita before you all joined, I think the main takeaway for all investment professionals um, is how not to lose money. I think the focus for the large part is about how you can double your money and triple your money, and there are all kinds of opportunities there, and both in the equity and the other markets, and leverage as an example. How you can make a lot of money with options and things like that. That's all great. I think making money should be one's objective, but I also think the folks on this challenge. My advice would be is learn how not to lose money, and if you stay solvent, if you don't lose your principal, the day you lose your principal, you're out of the game. So
That makes
staying
so
in
much
the
sense.
game requires that you risk manage your position in such a way that you do take small losses from time to time, but the focus is on making money. And a number of people have spoken about that. I clearly remember, we had one of the turtle founders, I think, at the last CMT Association conference, who mentioned that the even the turtle traders, when they traded, they would have a string of losses, but the losses would be small, and then there'd be a big win, and so the big win makes up for many of the small losses. And when you read books by different people, in different segments of this investing world, it's always about how to stay solvent. And in some cases, when you're working for a investment firm, it's even more stringent because your pay and your bonus will depend on how much money you make. And the moment you don't do that and you lose money and you lose your capital, they may forgive you once, they may forgive you twice, but the third time you're out. So you may lose your job. So I think that's my advice to you, and at least that's what I focus on in the work that I do. I do some research in that. I'll talk about that later. But basically,
Wonderful.
that would be
Right.
my message to my audience today.
Thank you so much, Somi. And I think, I mean, even as a young trader between in 2004, 5, 6, I remember my maxim was live to trade another day.
Yeah,
Just try not to get wiped out. Right?
yeah,
Let's come over to Eric. And Eric, I think you wear two hats as an investor and as a teacher. So, what are your thoughts on
Exactly.
this?
I'm even having another hat, which is research as well, as I write technical research for a regional broker. So that's one of the things I do, advise family office as well for the long term. But I mean, clearly I teach. university, and as well I manage money. So obviously, as the two sides of the coin, the advice I would give, I mean, first of all, I don't know if it's about seasonality, but I think the contest in August September is just perfect because it's always like last year. Last year they're like big down months, and then the whole way coming back. It was, I think it's
True.
fantastic for them to I mean, to tap off what had just been said, and I mean, Jesse Livermore. Only the game can teach you the game. So to start with, I think the contest is fantastic because you can read 20,000 financial book, investment book you want. It's very different because there is a human psychology. The moment that you put the trade on, it changes everything, you know. And if you don't practice that as a student before going into the real world, I mean, that's a problem. I mean, so I think there's a great opportunity to participate in that. That's why I put it compulsory for my students to be part of the contest, and the level of interest changed totally. I mean, they're just much more into the class. They have to check every week and get the basically the one most important thing is, I think, first big tip I would give is process. They start to learn that you need to have a process. If you want to stay in the game, you have to have a process. Stay in the game because the mathematics of investment goes against you. Once you lose 20%, you have to go 25. Once you lose 50, you have to double your money. So the simple fact that the investment money is asymmetric makes you much more intolerant to losses to stay in the game. But for that, you need a process. And the
That
process, you
is
need practice, and you need to review all the tools that technical analysis is offering you, combining having the blend. I always say the good wine is a good blend. I mean, a good technical analysis needs to have a blend of different indicators, which avoid the problem of confirmation bias. You know, you have to combine volume, you have to go on trend, you have to combine the MACD, the RSI, and avoiding repetition. So it's important, and be fractal as well. Third element, be fractal. Don't stay in
absolutely.
one little box of daily, of intraday. Look at weekly, look at monthly, look at even 40 years and say where are we in the trends, and use the macroscope, I always say, and the microscope. You know, they combine very well. It's not a perfect business. You have to stay in the game, but you have to reduce the probability of being wrong. And when you're wrong, well, you have to admit with humility, because the market always put you back in humility in your place, that you have been wrong, and don't impose your view to the market. You know, that's what I
Absolutely.
would say.
That's such a fabulous start. And Eric, I completely agree with you about the importance of process.
Yeah.
And only with process can you build a meaningful career, even long term. And you mentioned the word fractal, which is, I think, one of my favorite ideas in the world, and not just in the technical analysis, that everything operates on multiple time frames as well. So being flexible and not being married to just one time frame in your operations makes so much sense. So great. On that wonderful starting note, I'll turn the session over to Javan, Parth, and Mukul, and Kavita and I will disappear from here and come back when it's going to be close to 50 minutes from now, so that we can bring this conversation home. So
Yeah.
I'll leave it to the three of you. Maybe you can go in order, ask your questions, and when you have your questions, if you have it for a specific speaker, make sure you mention their name. If you want your inputs from both your mentors, do that as well. On that note, thank you so much, guys. We will see you in a few minutes. The session is
Great.
all yours.
Thank you.
No, so who wants to go first? I guess. Uh,
Hmm. You can go first.
okay, then I'll go. Hello, everyone. So let me introduce myself. So my name is Parth, and I'm doing my MBA from Sowmi Institute of Management. So I would say that before this, like in our college as well, we are more focusing on the fundamentals, and like that is something we're doing. And technical is something which I've like started learning for past 1.5 years, and like it's really intriguing how the market goes and up down, and something which I'm really looking forward to learn. I wouldn't say I have a lot of experience in it, but like really like just the basic student that I am right now. So my question is like when I'm working on support and resistance, so there's this false breakdown. So like how would I be able to like do not get trapped in it, and how can I like identify it?
Yeah. Eric, do you want to go or shall I take it?
To you.
Okay,
Well,
right. Okay, yeah, that's a very good question. That's a very good question, and most even experienced traders uh, get trapped in it. And in the trading business, what we call it is gunning for stops. So what happens is normally, as traders normally do, they will put stops below support, because if support fails, then it's going to go down, and you don't want to be part of it. And similarly with resistance, but the same thing applies. So there are these people who know where the stops are, or think they know where the stops are, and they will push it down to trigger the stops, and to benefit from it. Where it's the same thing, downside or upside. So the advice is, in terms of putting the stops, use a sensible approach. Don't put the stops too close to the support or too close to the resistance, because it happens. And a prime example of that, if you look at the weekly chart of the 10-year yields, that exactly happened, because the yields were trading in a down channel, and then it broke out of it, and then it came back and tested support and went through support a little bit, and we thought, okay, this is the end. But then it turned around and went right back up to where it is now at 4.35. So it's a fact of life. You have to accept it. And so my advice to all of you is to be sensible in your stops, and be aware that there are people gunning for stops. So you need to be able to, when you do your risk reward ratio, just make sure you factor that in and put the stops at the right place. That's the best you can do. But there's no way to avoid that. You know.
yep.
Eric, please.
Well, a good example is the dollar, right? In July,
Yeah.
I mean, the perfect long-term breakdown, not breakout in this case, breakdown, and it's always the same. From the breakout or breakdown, from false breakout or false breakdown, come fast retracement. That's not by chance. So usually when you have a false signal, it goes the other way, but at a faster way, and much deeper into the direction, the counter trend basically. So my take, what I do is you always have to leave. It's the signals are there. You have your grammar. You try to get most of your signals, but I mean that's where the art of technical analysis is coming into play. There's some subjectivity sometimes. You have to combine, look at the volume, look what's happening, right? Is it a breakout on volume? Well, that's not convincing. You cannot have a breakout without high volume, because without buyers, you can't have the confirmation, right? Same for a breakdown. Is it a breakdown really? What type of candle you have? And you really have to combine the volume, the different indicators, and see, okay, and let it some time. So I think a lot of mistakes in trading are the following. Everybody wants to try to make money. They forget that it's a business. To get into a business of investments, I mean, when you create an app, an iPhone, whatever, every company has a cost, right? Before selling, I mean, how do they say? It's expected revenue, expected return, right? But guaranteed cost in a company. In our business, is guaranteed loss, risk, guaranteed risk. You live in a world where the moment you put a trade, you have a guarantee that you're taking a risk, and you're hoping it's in the ER, expected return of all the equation of investment and fundamental, having a return. So, okay, I don't live on hope. I live that risk is guaranteed. So I have to let it go a little bit. The way I do when there is a breakout or breakdown, there is no other way to leave a confirmation. We need confirmation, and a confirmation of 2 or 3 sessions to see, is it really a breakout? Is it breakdown? For that, I have to pay a price. And accept that maybe I put 2/3 of my stop loss there, leave another third, and see if it comes back my way. But there is no other way to leave 3 sessions. Usually it has a rule of the 3, when a company reports big volume, look at the last week, and you need to take 3 sessions to see, okay, where is the bottom? Where is the potential change of trend? And when you have a breakout or a breakdown, I think it's the same. You have to let to see, is it really a true breakout or breakdown, or is it a false? Because you have to think that when it's a false, the fast retracement come in a big way, or the counter trend. So look at the dollar. Everybody was watching this 100 on the DXY. It broke by zero point 0.5, and the retracement is brutal. It's 4 points. On a currency, it's massive. So you have to know, okay, I take the risk that if there is no confirmation of that, I can lose much more on the retracement than just being patient to see, okay, it first falls or not. That's the way I approach it. I need confirmation, like in any technical indicators. This is part of, like people making mistakes using moving average in a sideways market. It's absurd. You wiped out all the time. Same here. When you have that, let it try to confirm that there is a breakdown or a breakout. Keep it 2 or 3 sessions, um, and look at your indicators. Look at the volume. Combine everything to see if it's really a true breakdown. Breakdown without volume, without a big jump in volume, you cannot have a breakdown or breakout.
Thank you, Eric. Thank you, Swami. That was really insightful. I'm gonna
Sure.
use these.
Yeah, you're welcome. Most welcome. Yeah, keep asking questions because we have some time. Um, Anything else on your mind? Please fire away. Good
Okay, so
question. Questions.
so one thing is like how like the main concept which I want to know, like what are the tips for risk management that we should be following? The main aim is to make sure that we are like making sure that there's like we are not making any losses. So how do we make sure? How should we go about risk management?
I'll let Derek take that first.
Yeah, I would say I always look down before I look up. Most of people
Yes.
look up before they look down. I mean, that's true. Everybody because people live in hope, and because
Yes.
by definition you invest to win. You don't invest to protect money. So before you look at a trade, you have to say, okay, where is my maximum pain level? Where is the level where I consider give whatever you want, a moving average and a historical price, or
Mm.
volume by price, you know, relative strength. You can combine everything. Say, okay, those are the levels. That's why in the S&P, for instance, I would for the clients where are the pain levels. That's the 20-day exponential, the 50-day, 4,025 was the peak of last August, and 4,200, which is the exit of the rectangle we had over the past few months, nearly a year. Where is everybody has a different tolerance, but let's say within these levels, the 20-day, the 50-day, the 4,225, the 4,022, you still in an uptrend. I mean, you're still not invalidating the uptrend in S&P, but what type of drawdown are you ready to accept? I mean, for someone, with very long term, maybe the 9%, roughly 9% from peak to 4,200 doesn't matter. For a guy which putting a lot of leverage or putting size and say, okay, after 3%, I have to be out. So you need to know those levels and say, okay, and always have a good risk reward ratio of at least 2 to 1. I mean, we are not flipping coins, that business, you know. 50-50 for me, I don't take a trade. Well, 5% of potential, 5% of potential, why should I risk money even though when the interest rate is 5%? I keep my money on the bank and I wait for a better risk reward rate. So at minimum, a 2 to 1. I want 10% upside, 5% upside, even more if possible. Ideally, 3 to 1. That's the way I would approach it.
Thank
Yeah,
you,
and
Eric.
just to build on what Eric said, one of the things to keep in mind is when you do these transactions and these trades and you do your calculations and you do your homework, things don't always go your way. Um, you can read about it. I don't know if anybody read the book on the Lehman collapse, and in that book, there's a chapter on GM that they talk about where Lehman Brothers in their heydays were the largest trading house on Wall Street. And just to cut to the chase, there's a really good book. I think as traders you would enjoy reading it. It's called A Colossal Failure of Common Sense. In case you haven't read it, there's one chapter he talks about. They went short GM, so they went short GM because they did the homework, and and when they did the homework, they have armies of analysts. Much more than we individually can afford to have, unless you're working for an investment house. And they studied that very carefully, and so they decided to go short GM in the market. and the price went up, and the price went up, and so they covered the shorts because that's good risk management, and because it disproved every bit of analysis that they had done. And so the sensible thing for them was to say, hey, if I let this run against me anymore, I'm going to lose my bonus. So they took out the short, and then they waited, and the market and prices went up even higher when it shouldn't have, and it, based on that analysis, and they shorted again, and it went against them again, and then went against them a third time. So it was like, you know, exasperating for them, and they couldn't quite explain why this was happening when it shouldn't have happened. So a lot of times, I think risk management is about responsible, stop setting and goal setting, as Eric mentioned. And then if it goes against you, get out, stay out, and go back and do your homework and understand why, what you thought was going to happen, because we all do our homework and we do look at all the indicators and everything, and sometimes even divergences, between RSI and price don't always pan out. So you do your homework, and if it goes against you, just get out of the trade, because something else is going on that we don't understand. So that's basically, I would say, because we're not always right there, and there's a saying about how the market can stay stronger than you can stay solvent, or some such thing. So it's always about being solvent and getting out of a trade when it doesn't go your way.
And I would add one thing about what just been said. There are two things which is always the killer for everybody. Two elements: leverage and position sizing. So that has been the killer for the big hedge funds, that's been of the big investors, because they're linked to the same bias, which is ego. You start to win, start to get better. You think that you own the world, and you start to go either leverage 5, 6, 7, 8 to 1. LTCM is that, I mean, the big hedge funds 20 to 1. I mean, stop 5%, you're out. Bye. And position sizing, it's a classic, have high conviction trade, whatever, and you start to lose the risk metrics. And you start to put 25% in one stock or one position, and say, guy, yeah, that's the one. And that's the one when you eat like a bird and you shit like an elephant. The one will kill your business. And it happens all the time. But people start to lose the discipline of risk management, saying, what type of position, according to my capital, I'm supposed to lose, even if my high convictions, and high convictions can, things can change. There are things you are not under control, but what you're under control is not what amount of money you put in every trade. And if you go leverage, how much leverage you're ready to make. And I think those are very important risk elements that always destroy a business. It's position sizing and it's leverage, and it's the same in the real world. It's a company betting on one product, or it's a company having high debt to equity, and all of a sudden interest rate goes up and they go belly.
Thank you so much for the answers.
You're welcome. Any other questions, Javan or Mukul?
Uh, yes. So, my question is, how can we plan a good exit strategy, or how can we put up a good target? Like in my last trade, I put up a target, but the stock price went after that also.
Right. So how did you plan your risk thing? Was it 3 to 1, 2 to 1? What did you do?
Sir, it's
How,
to the one.
2 to 1. Okay. All right. So, I, generally, what I do is I look at it as a 3 to 1. If I'm not making 3 to 1, then I'm not getting into it. As Eric said, right now you can get 5% in money market funds, and also T-bills in the short term. So, and if you look at some of these figures that they publish in many of these chart books and things like that, there's a large outflow of funds, into bonds lately, to take advantage, because this sort of thing didn't exist for 30 years, because for 30 years, from 1980 to 2000, interest rates kept coming down, from, I don't know, the high of about 18% down to zero. But now things have reversed and started going back up, which is actually a good thing for savers and that. But it also offers an alternative to your money. So always take a look at that as a bar. And then in addition, if you can make more than that on your equity trade, um, and at a ratio of 3 to 1, that would be a good trade. But there's always going to be times, even you know, instances where it's going higher even after you got out at 3 to 1. But that's the way of life. I mean, sometimes it could have gone the other way and you might have lost all your profits. But take, for example, what happened with Nvidia recently, or some of these stocks just before earnings announcements, and they just shoot up, and you make a killing. But these are, exceptions to the rule. So if you're in a steady market and you're making steady investments, and I'd say take your money and be happy.
Yeah, I have a rule on that, which is different because it's allowed to avoid this bias and momentum that we want to write. So first of all, when you put a trade, let's say that even if you have 3 to 1, 2 to 1, 4 to 1, doesn't matter. Basically, put your stop loss. Okay, we bought 100. Okay, bought 100. Then stock go when you have a target. I don't know. Let's say you have 120. Okay. What I do is that first rule, we go to 1, and you stop loss at 90. Let's say stop loss 90. You enter 900. You have 120 targets, 2 to 1. Okay. Then we start 100. Okay. Then we go to 110. We're halfway. My rule is the following. I say, and I think it's the worst thing that happened in investment is to let a profit turn into a loss. I think it's show for me very bad process and discipline. It goes to 110. I raise my stop loss to 100. Because worst case, I'm back to square one. I didn't lose money at least, right? And then the human beings worse in everything we do since we kid, we are working on rewards. Little nice kids, you get a sweet and whatever. What you do, you take one portion of the profit on the way before the target, right? 1/3 can be at 110. It can be, let's say, you raise your stop loss. At 110, you put 1/3 of the profit. What are the consequence of that? Imagine you go back to square one. At least you have some money in your pocket. You didn't do that trade for nothing, right? Then we arrive to 120. I take another third. It's my rule of the trees and thirds, the same.
Mm.
So I reached my target at 120. And I took another third. And you know what? What's the most complicated one? Because by definition, you have no idea. You set up a target of 120 at one stage, but it can go to 500. I have no idea. And that's where momentum is so powerful. I always said, I'm not interested in the first 10%. I'm not interested in the last 10%. I want to be the 80%, the meat. That's what people have so difficulties to do, to stay in the train. So how can I stay in the train? Well, my last 1/3 portion, once I reach 120, I raise my stop loss to 120 and I let it leave by himself. It's full surprise for 1/3, which can make up. You can say, hey, you took 1/3 of your profits halfway through. You took another, 1/3 of the target, but the rest, it can be Nvidia. It can go to 125 and go back to 120. I'm out. I don't know, but I don't care. Or you can change whatever. But if it goes to 150 to 160, who cares? My first idea was 120, and I took 2/3 of the profit, and this 1/3, it's like the box of surprise, That's the way I would do it.
Mhm.
Uh, and one more question, sir. So you mentioned about indicators in the starting of this session. So what are the top three indicators that you use or we can use in this challenge?
Price. Price is number one, right? Volume, price and volumes, they have always have to combine price and volume because one is normally distributed, the other not. The one give me an idea of supply demand, the other one give me idea of psychology, and urgency. So always combine volume. I look at volume compared to a 50-day moving average, for instance. So I want to, if there are spikes, and indicators, obviously, I look at my trends, look at moving average, but the most I use is the RSI, the stochastics, and the MACD, or PPO, which is the normalizing. Those are the main ones I combine. MACD is the best because it combines the trends, momentum, so RSI, but adjusted Connie Brown way, 80-40, 60-20. Uh, you know, Look at the personality of RSI is very important. Does it stays always under 50 even when it does a counter trend, or the pullback you reach there, but it stays in the overbought aspect. That's what I combine. MACD and RSI, volume, stochastics, and my price when I look at my trends and my Fibonacci retracement, obviously, as well. Why? Because 80% of trading is algorithms today, and they're programmed by computers, which are human being inputs. We look at the moving average, and you will see a lot of volume usually happening when there is convergence of important points. So, for instance, in the reports, there was in the chart report, like, look at the dollar. The dollar has a triple convergence. There is a horizontal price resistance, there is a totally moving average, there is a price trend from long term, there is sometimes a Fibonacci retracement, and when all that converge, the algos become crazy. Volume goes up, and those are the level before you break out, break down, when you really have to monitor when there is a convergence of important levels.
Right.
Krishnamurthy, sir.
Just to pick up on where Eric left off, you asked, I guess what you wanted to know, what are the preferred technical indicators to use. I would begin by saying, everybody has a different set of indicators, and not everybody uses the same. But there are some that are very commonly followed in the industry and well publicized. Say, for instance, RSI. There's not a day when you have somebody on CNBC mentioning RSI and so on and so forth. So there is RSI, there's MACD, there's PPO, and there's a whole slew of indicators that all these brokerage houses put up on their website. So what I would suggest is get comfortable, with a set of indicators that you think works for you. Um, and everybody is different in that regard. But pay attention, as Eric said, pay attention to price, volume, and breadth. These are the three, indicators generally that help you. So have a price indicator, have a volume indicator, and have a breadth indicator. And the breadth indicator is more of a sentiment indicator. So where is the crowd going? Is the crowd going for the exit or the crowd jumping in, on the bandwagon? So having said that, pick your own, and don't no need to follow the herd. Be your own, and get comfortable with indicators that work for you, and and just consistently test them out in different situations to see how they work. And one thing I'd say as a guidance on indicators, they don't work all the time. So you really have to be careful before you hang your hat on indicators. I mentioned to you divergences can happen for a long time, whether the market goes up or down. So the extremes, are sometimes not helpful. And you mentioned yourself, one of you in the beginning, that support is broken or resistance is broken, and there again. You have another example, and so even moving averages, there's a golden cross and death cross and all that. But take all that with a grain of salt, because sometimes a golden cross will exist for a month and then become a death cross, or as they, depending on whether the market is trending or the market's moving up. So some of the tools that I use. I look for, basically, I look past daily charts, I look at weekly charts, because weekly charts take out a lot of the noise in the daily charts, and and so it may not be suitable for your type of challenge, but generally as a trading rule, I start with the weekly and then I go to the daily from there, because the daily can give you entry and exit points, and then you look for charts where you have, as Eric mentioned, there was momentum, right? And how do you find out momentum? If you see a stock that's consistently trading over 5 years above the 50-day and above the 200-day moving average, and both these moving averages are pointed upwards, then this is a strong, stock to own. And you have to find the right entry points through the daily trades, through the daily charts. So even in this bear market, there are some candidates who qualify for that, because they consistently, keep moving above the moving averages, and with the moving averages pointed upwards. So these are some telltale signs that you can use. And of course there are others that like MACD, RSI, and so on. The other thing, the advice I would give you is take a look at what the volatility is in the market, because bull markets are the best way to put it is, bull markets are symbolized by low volatility conditions. They don't happen under high volatility conditions, because when volatility is low, when the conditions are right for markets to rally. And you can see this broadly as an example with the S&P 500 and the VIX, right? When you see volatility going up, the market corrects. So, but be assured that the market is in low volatility periods for 60 to 70% of the time, and then generally speaking, broadly as a rule of thumb, and corrects for the balance, 30 to 40% of the time. So you are in luck, because generally the trend is up, except for periods of correction. Those are the broad things that I would keep in mind when trading. If you see an equity that is making higher highs and higher lows, like the Dow theory, that's one you want to own. And if you think that's making lower highs and lower lows, then you don't want to own that until there is a change of character and it turns around and starts making higher highs and higher lows. So these are broad, very broad, guidelines that I would use to determine, which way prices are headed.
Yeah, I would add on that what somebody said. That seems pretty good. One thing I always say to students: don't forget, indicators just indicate. Everything has to be in a context. Price matters more. Indicators you can put, in your car, I want to turn left, I want to turn right. You put indicators and change. Oh, I have to go straight. I forgot that. The trend stays straight, right? So it indicates. You cannot take a decision based just on an indicator. It's always in the context of price. And one thing which was also mentioned, very important, that we didn't tap into. I mean, top down, we just talk about indicators of bottom up here, but top down is critically, it's context, right? Breadth of the market, new high, new lows, all that is really key, because you cannot make a harvest in the wintertime. In which context are we in? Trying to pick up pennies in front of a massive bear market is a strategy that's going to be a failure most of the time. So, I mean, how many stocks are trading above the 50-day, 200 moving average, the differential new high, new lows, statistics basically. You don't look at stocks in the top down market. You just look at figures. It's statistics. I don't care if it's Apple, uh, if it's any stocks. I just want to see what's the context of all the as a statistic concept, and from there see if the environment I'm trading with is conducive or not. So that's important too.
Thank you, sir. Thank you for your input. Javen, you can go on.
Okay, following up with a bit of Muku's question. So, in terms of indicator, is there a certain parameter that you use? I mean, as in, do you do a cycle analysis prior to that, to customize certain parameters for the indicator, like 20 days, 14 days, 15 days? Is there a process behind that you can fine tune your indicator better to certain tickers and price behavior?
Yeah. Eric, you want to take that, or I'll follow?
I think once again I will tap into what Sowmi just said. I think it makes a lot of sense. You have to have indicators which you are comfortable with. Everybody has a different setup, personalities. People are more long term, people are more short term, and there are set of indicators where you basically are in sync with, right? I mean, let's think about it. RSI 14, where does it come from? People want to realize most of the time it's half moon cycle. It's simple as that. So why 14 is half moon cycle? Okay, well, I think RSI 9 weeks, for instance, on gold works very well. Cycle, obviously, cycle president cycle worked perfectly this year. 30 years of president cycle is exactly, and second year president cycle was perfect last year too, and seasonality with that. I mean, you have a lot of statistics when you can really break down which months are valid, which part of the month. It's not by chance the third week usually bad. It's option expiry related. It's not by chance the last part of the month and the first part of the month are better because then it's flows related to 401k. I mean, even more in the Indian market now with all those compulsory money that workers have to put in in pension and all that. I mean, those are implication flows, flows by stuff. So that early of the month usually you have a better concept. Fridays, it's taking risk of the weekend, so it gives you a lot of psychology of the market. If people wants to hold stuff, last year all of Friday went nearly down with the Iraqi war, the Ukraine war, when nobody wanted to hold position over the weekend. So we had a lot of Friday this year when the Chinese market were going up. People wanted to have risk in the portfolio. So all those things give you an idea of psychology, seasonality. But RSI, of course, if you look at a weekly or daily basis, it's a different aspect. Why would you look at 14 weeks? People look at sometimes 5 days or 9 days RSI while they use Fibonacci numbers. Sometimes some of them, I want to have 8 and 13. People look at 13 weeks moving average, 21 days moving average. I think, as has been so mentioned, it's all you feed in harmony with indicators. What type of period is more convenient for you? But usually, I like to look at different macroscope, microscope, opening up, opening down, and see, okay, is there a convergence of levels that I can find from the weekly, the daily, or the intraday that really matters?
Yeah. Right. I got a response that's in two parts, and I'll elaborate both parts to you. Let me first start with the RSI as an example. And Eric mentioned 14, and he asked the question, why 14? So, yeah, I would ask the same question. I'd say, why 14? Why not 10? Why not 8? Why not 24? So, what I suggest you do, if when in doubt like this, there are certain trading systems that are available to you, and many of them are free. Some you have to pay a subscription. So play around with it, okay? So you answer the question yourself by changing the 14 to 9, right? Or changing it to 20. RSI as an example. And what you'll find is as the number decreases, if you get to smaller and smaller numbers on the RSI, for instance, you'll see too many jagged edges on the RSI because it's responding to every bit of noise, right? But then if you keep it very high, like 25, then it just becomes like big waves. So there's some point in between 5 and 25, and I think many people landed on 14. But 14 there's nothing religious about 14. I personally prefer 9 as an example because that takes it's not noisy, with those jagged edges, but then it's not too much of like a sine wave or something like that. So it's somewhere in between. So I use 9. A lot of people use 14, but get comfortable with what works for you. That's one answer. The second part of my answer is about these moving averages that Eric mentioned, and it's quite fascinating. I think um, the street follows widely the 50-day and the 200-day moving averages. And not a day passes on the media where you hear about the stocks traded below the 50-day or the stock traded above the 200-day. And we even have indicators, breadth indicators that say what percentage of the stocks are above the 50 and what are above the 200. And so that becomes a self-fulfilling prophecy. It becomes valid because everybody's using it. That's why it's valid. So there's no reason why, because an average trading month is 21 days. An average trading quarter is 63 days. And then you can multiply that to get as many days as you want. But sometimes it's easier to go with the flow because if the whole street is watching these averages, and really amazing. I've looked at some of these charts lately, and prices have come down, touched the 200-day moving average, and then bounced back. So what was so special about that 200-day moving average is still beyond me. But it works because most of the street follows it, and you hear this often. It's a really good buy because it's at the 200-day moving average. But you got to do a little bit more work than that and see if there's a confluence of indicators, as Eric mentioned earlier, which is, does that 200-day moving average coincide with the Fibonacci retracement? Does it coincide with prior highs or prior lows? What is so sanctimonious about this spot? And that's where you can add value to the whole equation rather than following the herd. So I hope all of this makes sense, and it's just not a simple matter, but from trial and error, you'll get good at it. Another example, Bollinger Bands, right? Everybody uses 20 period Bollinger Bands and 2 standard deviations. So why not 3 standard deviations? Why not 25 period moving, Bollinger Bands? So most of the street uses 22, and that's what it is. And that's why when you draw a Bollinger Band on a price, you see it's skirting the upper band or it's skirting the lower band because most of the street, uses that. Um, but make sure when you're doing that, I mean, this is by and large in equities, but when you go to other, commodities like currency, as an example, which Eric talked about a lot, and I found that even for the 10-year treasury yield now, right? When I look at the weekly chart of the 10-year yields, TNX, right? I find that the 30-week and the 60-week moving averages work really well. I have no idea why, but it seems like every time it comes down to these numbers, it bounces back. So there's no one size fits all is the best answer I could give you. But keep in mind, what a lot of the streets follow. You hear about, Fibonacci retracements, very common, moving averages, very common. So also remember that a lot of people are using that too. And sometimes it becomes a self-fulfilling prophecy. Yeah.
Okay, my second question is that, okay, as a trader, sometimes we have the urge, to find new trade ideas every day, because we want to get new ideas to trade, to find potential opportunity in the market. So how do you weigh against finding new trade ideas versus trading on those that you're already familiar and as successful, because you are able to understand the price behavior much at a higher confidence level? So
Right. Yeah, that's a very good question again. There's a whole universe of stocks, bonds, and commodities that you can trade. Um, so if you're comfortable with a certain instrument that you trade and you trade it all the time, then you can keep on trading it. There's no reason to go away from it. You can continue to trade it, but keep in mind that if you want to be an active trader, you need an inventory of trades to follow, and once again, you can get trade ideas from a lot of different sources, including these subscription services where they give you a list of stocks trading below the two standard deviations of the Bollinger Band, or stocks trading about the two standard deviations of the Bollinger Band, or whatever it is. If you think you have a candle arrangement that works for you, like a bullish piercing, they'll tell you which stocks are showing bullish piercing at a given point. So you can get ideas from there as well. So the wider you cast your net, the more ideas you get. But there's nothing wrong with sticking to the tried and true and things that work for you.
Yeah, I would say the two things that people have least in the investment business is discipline and patience. Discipline is process, and patience is like the human urge of doing stuff. And sometimes not having a position is a position. But like a big hunter, you have to wait. You have to wait. Some people, they go to fish, they go to fish the whole day, they come back without a fish. Same for the hunter, go in the forest and didn't hit anything. That's okay. That's okay. That makes you this makes you the opportunity to work on your process and saying, okay, if it's nothing coming out, taking position for position is the worst decision you can take. Second, I would say it's a natural thing of what you're telling us. I mean, it happens to everyone. There is always, I would call it like the wife trait, if I can say. There is that stock that you're always dating, and it's there, because you know it so well that when the stock is unhappy, when the stock is happy, it's exactly the same. You just put yourself so much into it that its pattern. You start to see its personality moving. So the candles, that's the one crossing the hit, the expansion moving wedge with such a candle of volume. That stock is going to go down or whatever, because you have the affinity. Why? Because you train your high. I mean, to be a good technical analyst, you need to train your high. You need to see charts, and you need to see. Sounds like become a joke, but you become a matrix, right? You start to go through the things, through indicators, and say, hey, in that chart, I see that because you have been training your eyes. That's why this challenge is important. You have to look at charts, and you start to see the personality of a stock. The third element I would add to that, I mean, that's where the challenge is, because some people say, hey, I'm good at CZ, I'm doing the asset class. The good thing about technical analysis, it's a grammar. It's a grammar that you can apply to very different language, if I can say. Equities, bonds, commodities, forex. I mean, if you don't see an idea where you are used to, I mean, challenge yourself to say, okay, let's move out of my comfort zone. Let's trade some FX, let's trade some bonds, let's trade some commodities, supply demand anyway. So, and get signal from different asset class. We need you reaching the third level of the CMT, intermarket analysis. Things happen for reasons. Flows go to, asset compete for flows. Fixed income, commodities, equities, they work against each other, sometimes they reach against each other. You need to, and by broadening up your space, you will have a better integrated process, I think, and going into intermarket analysis. That's a good way as well to, when you don't have a trade in your space, well, maybe look at another space.
Yep.
Okay, thank
I'm
you.
just jumping in, guys, for a quick time check. We have about 4 minutes to go. So, any of you, Mukul, Parth, Javan, if you're feeling that there are any last minute questions you'd like to sneak in, now is the time.
Okay, so I can ask a question. So since the challenge has started, S&P 500 is falling. So if you were a part of this challenge, so what would be your approach towards this?
Right. Yeah, good question. Very good question. In fact, because that's what I do every day. Follow the S&P 500 to see where it's going. Um, to me, I think there is a correction underway, and you look at it in a lot of different ways. But the correction may be going in certain direction for certain stocks and not all are following the same. So when you do the analysis of S&P, you have to do the analysis by sectors and see which sectors are strong and which sectors are weak. And in sectors, in every sector that you look at, see what's going on. If there is a correction going on, is it making lower highs and lower lows? And if it's making lower highs and lower lows, then the correction is not over. It has to turn around in character and start making higher highs and higher lows, which means you're not going to pick the bottom all the time, but you will at least know when it makes a higher high and a higher low, then there is a change in character and a change in trend. So you find out which sectors are doing that, and you start with the weekly chart and also go down to the daily chart, and then you'll find the answer yourself.
You mean the S&P itself or stocks within the S&P? But that's a very different question.
Yeah, well, and I said the S&P is just a conglomerate of these sectors. So my advice is on the sectors, focus on the sectors more on the S&P, and then you'll get a much higher return if you focus on uptrending sectors in the market. As an example, lately, energy and healthcare have been doing well. So if there's a correction in that, find out if there's lower highs and lower lows or higher highs and higher lows, and decide accordingly. If that makes sense.
Yep. I don't know if you can share something here. Yeah, going to try to share something here.
Yes, you can, Eric. So what you need to do for that is go to the present button at the center of the bottom of the studio, and when you share your screen, it will pop up in the studio section, and I'll be able to then project it onto the screen. Here you are at the screen.
So I'll quickly open it up, pretty easy stuff, That's what I say first, know your levels and Fibonacci retracement, from peak to trough. What is important, 16.8 is 4,100, close to 4,200, not a coincidence. 4,225, the peak of August. We broke the 20-day moving average, and we moved the 50 on purpose. We just want to have a clean chart here. The 200 is there. So, principle of technical analysis. Higher lows, higher highs, right? So, higher highs, higher lows. Okay, higher lows, it's about 4,200. It's going to merge more or less with the 200-day moving average and the 61.8% Fibonacci retracement, which coincides with the exit of the rectangle that I was mentioning. So very key level. At 4,200, we're still in a uptrend. We're in a correction of an overextended market where you can change the personality in the RSI on the bottom. The RSI was permanently above 50, this yellow area, where basically the low were around the 40 something. And all of a sudden, we have a change of personality in the RSI. Right? First time we go towards the 30, right? So I think it's, as I mentioned, it's a pullback within an uptrend. It was overextended. And one of the lifeblood of a bull market is rotation. So that's why what Sowmi was mentioning, you have to, at the level 3 of CMT, relative strength. We want to pick the winners, So you need to look at the sector rotation. There is currently a sector rotation from growth into value. Obviously, the weight of energy, healthcare, all that is not enough to compensate for technology, communications. So it's discretionary in the short term. Where do you find it at bottom in the market? I think when the moment when growth is coming back, because that's where the impulse will have to come for the big locomotives, right? So you look. The context is a pullback. The context is a pullback, so you need to go find relative strength and keep dry powder when you can press the level that you consider will be the more interesting to buy the market. This is the S&P, but if you look at the small cap, we already have a 20-day moving average, for instance, right? So there are different parts of the market, but I think relative strength is really key to find, and within the sector, when you find which stocks are leading within the sector as well. And that's where if you want to buy momentum, that's what you want to do.
I think that's a fabulous response, Eric. And I think, Sowmi and Eric, both of you, these markets, I think, justify, like you said, Eric, the reason to have an investment challenge like this is to give folks an experience of these downtrends, these and sideways markets, and remind everyone that markets are not just about uptrends. And yet, Mukul, to your question, within a universe of 500 stocks, even if the index is dragging downwards, not all stocks will. Relative performance will always suggest that there will always be some that are lagging the index, some that are leading it, and trying to understand where the opportunity lies within these is really where the juice is, as it were. And that's why I think the body of knowledge of technical analysis is wide enough to create all these learning opportunities. And for all of you going through your journey of learning technical analysis, ensuring that there is enough rigor in the way that you approach a discipline is critical. But on that note, we are on the hour and a minute and a second. And so I want to thank all three of you, Javen, Parth, Mukul, for joining the session. You guys have asked some very good questions. You've completely rendered Kavita or me redundant, which is always a good thing. And Sowmi, Eric, always a pleasure to have both of you on board. I mean, I honestly feel that the true value of the investment challenge comes not just when the participants kind of enter their trade ideas, but coming and getting together like this, discussing processes, discussing mindset, discussing technical analysis from a kind of top-down perspective is incredibly valuable. So the two of you really make this journey worth it. Thank you so much.
Sure. It was
Thank you for the invite.
good luck to all the participants in the continuing journey, and all the best to you.
And on that very pleasant note, I'll wish everyone a very good day, and we'll see you next week.
Yeah.
Meanwhile, we are planning some other interesting knowledge sessions as well. This is for the benefit of anyone who will be watching the session later in the week. There are a couple of other interesting sessions as well that we are planning, and I'll keep everyone posted on Discord. Have a great day, everyone.
Thank you.
All right.
Good luck.
Thanks.
Thank you so
Thanks.
much. Thank you.
Yeah. Bye.